It's worse than we thought as the manufacturing sector is crashing. I'm your host, Steven Van Metre, and thanks for joining me today. And the U.S. manufacturing sector has been a bright spot of the U.S. economy as manufacturers have benefited from higher prices, higher demand, and global supply chain disruptions. And this has been passed down to the broad economy, and workers have enjoyed stronger employment and wage growth. But that story is soon changing as the June data is already telling us that the manufacturing sector is crashing. And it's going to take the economy down with it. Let's head over to the Texas Fed, where we picked today's story up, who headlines that the Texas manufacturing growth abates and outlooks worsen. And growth in the Texas factory activity decelerated sharply in June. Now, mind you, this is a time when people thought the global economy should continue to grow, according to business executives responding to the Texas Manufacturing Outlook Survey. The production index, a key measure of state manufacturing conditions, fell from a high of 18.8 here recently down to 2.3, a huge drop, reaching its lowest reading since May of 2020. And other measures of manufacturing activity also moved down notably this month. The new orders index dipped into negative territory for the first time in 2 years, falling from 3.2 to minus 7.3 and signaling a decline in demand. And this is a key point because new orders are the future. They tell you what is coming. So for example, if I was a widget retailer and there was a lot of demand for widgets and I had customers coming in and buying them like crazy, what am I going to do? I'm going to put out a lot of new orders to build up inventory. So what happens when those new orders start to come down? It's a leading indicator of where demand for the economy is going, and this is bad news. The growth rate of orders index pushed further negative from minus 5.3 to minus 16.2. The capacity utilization and shipments index remained positive, but fell from 3.3 to 1.2 respectively. And perceptions of broader business conditions worsened again in June, again something that we're being told should not be happening. The general business activity index declined 10 points to minus 17.7. The company outlook index also fell 10 points from minus 10 to minus 20.2. And both indexes reached lows last seen in May 2020. The outlook uncertainty index shot up from 43 to 43.7, a 17-point jump from May, suggesting a complete reversal in what we're hearing about in the economy. And just weeks ago, we heard from the Fed, who said the economy is in great shape, is on path to actually raise rates here again in the next few weeks. But according to what we're seeing coming out of Texas and some of the other regional Fed research surveys, it's bad news that suddenly something in June caused a big shift to the downside. And labor market conditions continue to indicate robust employment, so some good news in growth and longer work weeks. But one thing to consider is employers don't immediately start laying off people just because they see a slowdown in new orders. There's a lagging effect there, which we'll look at some charts here shortly. The employment index moved down 6 points to 15.2, but remained well above its series average of 7.7. And at 24% of firms noted net hiring, while 9% noted net layoffs. The hours work index pushed up further from 7.4 to 11.8, and all good news for the employment sector. And expectations regarding future manufacturing were notably less optimistic in May. The future production index remained only slightly positive, retreating from 19.9 to 4. The future general business activity index pushed further into negative territory, falling 20 points to minus 26. Other measures of future manufacturing activity also declined, though most remain positive. So what you're seeing is when we talk about growth and inflation expectations, this is telling you that future growth expectations are going down, and that should give you an indication why stock prices are going down. And when, as I'm going to show you in some charts, when you start to see new orders fall, well, that is a great indicator for not only further outgrowth, but inflation expectations. Let's take a look at some charts now, see if we can make sense of what's going on here. And here we can see these general business activity, the diffusion index for Texas. And I want you to note here that going into the great financial crisis, we saw this slowdown coming out of Texas. And Texas is real key because, of course, the energy sector. And noticeably, we had a recession. And then what happened? Notice here it peaked kind of in 2014 again after kind of moving sideways and started trending down. We almost had a second recession here around 2016. And then going into the pandemic, we were on track for a recession. Well, that didn't happen. We ended up having a pandemic, loads of fiscal and monetary stimulus, and now look, we're headed back down. And if this trend continues, it is an ominous sign for what's to come. Now, what does this have to do with oil prices? Well, it's Texas. And I want you to notice that there is a pretty good relationship between the general business activity index for this Fed survey and the price of West Texas Intermediate crude. And you can see that they kind of work and go along together. And there's 2 points that stand out here. Noticeably, going into the great financial crisis, we saw business activity coming down and crude oil prices rising. We see that same relationship happening now. And the question you should be asking is, why is that happening? Is there some new regime change, something different that's going on? And what it's telling you is that high oil prices are cutting into economic growth. And so there's a point where you want higher commodity prices, you want higher energy prices, because it means inflation's taking hold and you're trying to get your economy to grow. But if they go too fast, or the economy doesn't keep pace with them, perhaps wages aren't keeping pace with them, what it means is now those higher prices, those higher energy prices are becoming a drag on economic growth. And then what will happen is this. What we'll see is crude oil prices come crashing down as, of course, the business activity in Texas continues to slow, which is likely to happen. Now, what does that mean for gas prices? Well, many people believe gas prices aren't coming down either, but notably see the same trend that happened with gas prices against the general business activity diffusion index for Texas. Notice gas prices rising in red, diffusion index slowing down, and otherwise they're fairly well in sync. But look what's happening now. Business activity slowing, gas prices rising. Tell us the same thing was happening with crude. The gas prices are too high. They're becoming a drag on growth. And ultimately, when growth starts to fall, inflation comes down with it. Let's continue on, because now we're going to talk about the future, new orders. So this is the lifeblood of the economy, is you want to see new orders coming in. And notably, we saw new orders slow down going into the great financial crisis. We saw them slow down going into what was a second recession here in 2016. We saw them slowing down going into the pandemic, which would have likely been another recession. And now we see a fairly high peak of strong demand for new orders, and that is coming back down. And it has major implications, because when we look at the consumer price index, which will overlay here in red on a year-over-year rate of change, notice that you can have rising consumer prices as new orders go down. And then what happens is consumer prices come crashing down. And otherwise, you'll notice there's a fairly decent relationship, because when you start to think about it, we'll go back to being the widget retailer, is if all of a sudden I have all these new orders coming in and I see demand slowing down, so I start cutting my new orders. Now, what does that mean for my ability as a retailer to continue to push prices higher? See, if demand remains strong, then I can continuously push prices higher and higher and higher. But if demand slows, not only can I not push prices that much higher, I may actually have to cut them. And that's what we see happening in this chart here as new orders slow. Well, yes, you can still have rising inflation, but then all of a sudden as demand goes away because people can't afford those higher prices, consumer price index comes down, suggesting that at some point, and we may see the consumer price index continue higher, but it's likely to head lower. And what does that mean for the stock market? Well, let's overlay the Wilshire 5000 now in red on a year-over-year rate of change, and you'll notice a nice relationship here. And as new orders go down, well, the market's heading down. That's the wealth effect. But imagine this. If we continue to see new orders slow, it's telling us the economy is slowing faster than the market thinks, and that could lead to a steep sell-off in the equity market in the future. How about the bond market, which everyone believes interest rates can only head higher? Well, look, when we overlay 10-year Treasury yields against the current new orders diffusion index for Texas, notice the nice relationship here. And this makes sense that as new orders slow, well, rates have to fall. And you start to, again, challenge, why does that happen? Well, again, if I'm selling widgets and I'm having trouble selling them because demand's going away, well, how do you bring demand back? What is one way to do it? Well, if rates go down, then people perhaps that may want a widget in the future but can't afford it today could finance it. And that's why you see rates tend to fall. Again, growth and inflation expectations. As growth comes down, and demand comes down, inflation falls with it, and yields should come down. But now what's happening is a little bit of a different story. We can see otherwise this relationship is pretty solid, but what's happening now as of late kind of 2021 We see the surge higher in rates as everyone believes now rates must go higher, and look what's happening to new orders. Demand is falling, and what is that telling you? It's the same thing that happens in the energy sector with crude oil. It's saying, look, if high oil prices, high energy prices are causing a drag on the economy, look what high interest rates are doing. The same exact thing. So rather than people going out and being able to finance and keep the economy going, well, they're turned away by high interest rates and say no, and that is causing a problem and leading to the economy to slow faster than most expect. And what does that mean for, of course, rates? Well, as new orders likely to continue to slow, it means rates at some point are literally going to go straight down off a cliff and erase much of these gains and perhaps even more down to new lows. And how about when it comes to employment? We talk about how employment's been strong due to the manufacturing sector, but with a lag. Notice how new orders slow down. And with a lag, we have the non-farm payroll report, which we'll get next week on a year-over-year rate of change. And notice how the growth of it starts to slow. And then, of course, eventually it contracts against where we see the baseline of this black line, as what happens is manufacturers and employers keep people on until it becomes obvious demand is going away. Another way to look at that is the 4-week average of initial claims. And what you can see as new orders start to fall, what happens is new claims on a new unemployment claim start to slowly rise. So you're not seeing as strong of hiring. You see it's just a bit of layoffs building, and then it starts to accelerate as demand falls. And lo and behold, what do we see back here going into the pandemic? That initial claims were flatlining and starting a trend higher. And what do we see now? New orders coming down and initial claims starting to rise, putting validation that the economy is slowing at a rapid pace. And if this continues, it's bad news for the economy. It means stocks are going to crash, and it means interest rates are going to fall at a time when most investors have sold out of the bond market. But there's a strategy out there that can hedge with bonds and hedge that downside risk with them, and that's Portfolio Shield. I'll put a link up here in the corner and description below. Check it out, and when you'll see it makes a lot of sense, you get what it does and why it's such a powerful hedging tool. But let's get into today's data, which what we find is the trade deficit has shifted, and that has also big implications for inflation and what is to come for the economy. And here we have over to Bloomberg, who headlines the U.S. goods trade deficit narrows to the smallest this year on record exports as the shortfall shrank in May to $104.3 billion as exports picked up. And one thing I want to point out here is when you see $104.3 billion, what does that also mean? It means there's $104.3 billion that left the United States and went overseas, and those get recycled back to the U.S. economy. Now, not all of them come back. Some of them go to pay debt, some of them are saved, and some of them go back to purchase Treasury securities, which is notable. So when you see large deficits, you see that foreign investors, foreign central banks have dollars to get recycled back into the United States. And it's important they do that. But when they slow that down, it becomes a problem. But the notion right now that foreign investors don't have dollars to recycle back, well, you see it. They have quite a bit. As the commerce data also showed an increase in retail inventories, suggesting, as we just talked about, that new orders are likely to further to fall. Exports rose 1.2% to $176.6 billion, while imports were little change. So really the change here was driven perhaps entirely by exports, as U.S. retailers and manufacturers have stepped up efforts to build stockpiles amid uncertainties in logistics networks to ensure that they're able to meet robust demand. And see, I disagree with this point completely, because what have we heard from Target and Walmart and other retailers? They bought the wrong inventory. They thought people were going to continue to spend on certain types of products, and all of a sudden, as the economy reopened, spending shifted, and they're stuck with inventory people don't want. Now, they might want it in the future, but they've got to sit on it, or they've got to discount it. So the notion that retailers got this right and are just stocking up because of supply chain issues, not true at all. The risk, however, is that sales of merchandise weakened more than forecast as some consumers spend more on services. And retail inventories rose 1.1% in May to $705.3 billion from a month earlier, as the story of rising inventories continues. Again, they say as companies stock up on merchandise, mainly merchandise people don't want, and we know due to inflation can't afford amid still uncertain supply chains. Stockpiles at wholesalers climbed 2%. And in the first quarter, the widening of the trade deficit largely explained the economy's worst performance since the pandemic recovery began. And that also is not true. In fact, what I want you to think about is how does the U.S. economy grow? We're the largest consuming economy in the world. So what would you expect? If you said, I'm going to look at one data point to determine if the U.S. economy is expanding, well, you could just say there's imports. If there's a lot of goods flowing into the U.S., that means there's demand from U.S. consumers and the economy is expanding. So when you see a widening trade deficit, and we'll look at a chart here in a little bit, well, it should mean the economy is expanding, not, as this article suggests, is just the opposite. With the worst performance since the recovery began, with gross domestic product shrinking at an annualized 1.5% since the start of the second quarter, the trade gap has narrowed substantially. Well, not that much. And exports were boosted by gains in industrial supplies such as petroleum products, as well as increases in the value of shipments of consumer goods and motor vehicles, so mainly due to the export of oil, as U.S. merchandise imports eased 0.1% in May from prior month from $280.9 billion. Inbound shipments of consumer goods dropped 2.4%, while imports of industrial supplies rose 2.2%. And here you can see in some charts, we're going to overlay now the trade deficit or trade balance goods and services in blue. And you can see, now this doesn't get updated with today's data. I don't know why the Fred database doesn't get that quite right, but it's actually down here around 104 billion. And we're going to overlay this against the GDP growth on a year-over-year rate of change. Now you can look at this and say, well, I don't quite see the relationship. Well, I jumped forward by mistake. But what you should notice is as trade deficit goes down, GDP growth goes up. And we see trade deficit going down, GDP rising. It's not until you see the trade balance going the other direction that GDP, of course, starts to slow down considerably. So again, kind of rebuking the article's point there that this has actually been a good sign until it becomes a bad sign of too much inventory. How about when it comes to the consumer price index? Well, you can look at this relationship here now when we overlay the CPI and a year-over-year rate change. You say, well, I don't quite see it, but let's now invert the trade deficit and you'll see exactly what we're talking about and talked about in previous shows, that when you see high consumer prices in the U.S., you get a lot of foreign imports because they have lower costs. So they can compete with U.S. manufacturers and they want to get their goods here because they can make a lot more money on the fact that prices here are higher. But notably, what happens and what I want you to see here is when the trade deficit shifts and goes the other direction, what it means is inventory levels are too high, there isn't enough demand, and that means less orders, less imports, and lo and behold, it means less inflation. So when we see, again, trade deficit showed inverted, when it starts to head down, as it's slowly starting to now, it means the future of consumer prices is lower. And how about retailer inventories? Well, when we overlay that, you can almost see that we need to invert something again. And when we invert the trade balance, what do you notice? Again, you see rising trade deficit means, of course, rising inventories. And if inventories aren't being eaten up during this relationship, ultimately what happens is the reverse happens. The trade deficit goes the other direction and starts to narrow. And of course, that means that inventory levels have to go down to eat up all of that inventory before, once again, the system can restart. And how about when we look at investment from foreign companies and international investors and central banks of U.S. debt? Well, here we can see federal debt tends to rise, that's held by foreign and international investors, as the trade deficit widens. And it's easier to see when we invert, of course, federal debt. And what we notice that as the trade deficit widens, they have to buy more and more Treasury securities. And it all makes perfect sense because when you get it, you understand that they have more dollars and need to be recycled back over into the U.S. And with that, we'll wrap up today's show. Appreciate you being fans. Appreciate you watching. I'm Steve Van Metre. Bye now.